Welcome to the Wednesday edition of Tech Stocks Daily, your go-to podcast for the hottest market moves. Today, we've got a roller coaster of tech news. Google slashing pixel prices, CrowdStrike's stellar Q1 results, Autodesk facing a legal trifecta, and MongoDB's stock nosedive. Want the scoop on Google's pixel discounts, YouTube's mysterious like button bug, and executive shakeups? Curious why CrowdStrike's stock is soaring, or why Autodesk is in hot water with investors? Plus, find out why MongoDB's future in AI might not be as bright as it seems. Stay tuned. Hey tech enthusiasts, welcome to today's buzzworthy tech rundown. Today, Google's got the limelight, making waves with a series of developments that are as varied as they are impactful. Let's dive into what's been happening with this tech behemoth. First up, Google is stirring some excitement with a major price slash on its Pixel 8 and Pixel 8 Pro smartphones. We're talking discounts of $150 on the Pixel 8 and a whopping $250 on the Pixel 8 Pro, some of the biggest price cuts we've seen this year. This means you can now grab these flagship devices at significantly more affordable prices. But wait, there's more. Google is upping the ante on its trade-in values, offering jaw-dropping returns if you trade in older Pixel models, and even going head-to-head with Apple by providing higher trade-in values. For instance, trade in your Pixel 7 Pro, and you could get up to $500. Plus, if you're a Google Fi customer or a Google One subscriber, you're in for more sweet bonuses with cashback and store credits. Folks, this kind of deal means now might just be the perfect time to swap out your old phone for some fresh tech. Next, let's shift gears a bit and talk about a mysterious vanishing act happening on YouTube's web interface. Numerous users have reported that the like button is playing hide and seek. It registers your likes but then disappears into thin air right after. Yep, it's a known bug, and YouTube has assured its beloved users that they are on it. While you might be faced with a blank space where the thumbs up used to be, rest assured, your likes are still counted. They'll keep updating us on any fixes, so stay tuned. On a different note, Google's executive team sees a significant reshuffling. Google's chief privacy officer, Keith Enright, is bidding farewell after 13 years with no immediate plans to replace him. Instead, Google will be restructuring its privacy and compliance teams to spread the workload across multiple groups. The same goes for Matthew Bai, the head of competition law, who's also leaving after a 15-year tenure. These departures come amidst a backdrop of growing scrutiny over Google's privacy practices, especially following some eyebrow-raising revelations and lawsuits. Earlier this year, we saw Google navigate through some stormy legal seas around their data privacy practices, and they'll likely continue to do so as new leadership takes the helm. Lastly, on the finance front, Google parent Alphabet has appointed a new chief financial officer, Anat Ashkenazi, previously with pharmaceutical giant Eli Lilly. Starting July 31st, 2024, she'll be stepping into the shoes of Ruth Porat, who has been pivotal in steering Google's financial ship. With a solid track record of fostering long-term growth and investment, Ashkenazi's entry is anticipated to fortify Google's financial strategies further. This announcement has already nudged Google's stock up a tad, signaling investor optimism. Phew, that was a lot to unpack, right? Google is clearly operating at full throttle with price cuts, interface tweaks, executive shuffles, and strategic hires. Whether you're a Pixel fan, a privacy advocate, or an investor, today's news has something for everyone. Stay tuned, keep liking, and watch this space for more tech updates. Hey tech fans, hold on to your firewalls because CrowdStrike is making serious waves today. If you haven't heard, CrowdStrike Holdings, the high-flying cybersecurity firm, just reported its fiscal Q1 2025 results. And let's just say, the numbers are causing whiplash for all the right reasons. The stock soared by close to 12% this morning, so let's break down why everyone's talking about this cyberslinger today. First off, the revenue numbers were nothing short of spectacular. CrowdStrike pulled in $921 million for Q1, marking a 33% uptick year over year. That's a cool $15 million more than the $906 million Wall Street was expecting. It's like showing up to a potluck with a 5-tier cake when everyone else brought chips. It's just plain impressive. Now, what's even juicier is their forward outlook. The management must have had a crystal ball because they modestly adjusted their full-year revenue forecast to approximately $4 billion. Yep, you heard that right. This means they're confidently predicting a 31% growth. And for those crunching numbers at home, that's almost as impressive as a cat landing on its feet. The profitability metrics also had everyone doing a double take. Free cash flow jumped to a record $322 million, boasting a stellar 35% margin. For those who might not speak fluent Wall Street, that essentially means they're making money hand over fist while keeping their expenses tightly in check. This company is not just running, it's sprinting at an Olympic level. One thing that got analysts particularly giddy is CrowdStrike's annual recurring revenue, which shot up by, you guessed it, 33% to a mind-bending $3.65 billion. ARR is a big deal because it indicates long-term revenue stability, like having a never-ending subscription to your favorite streaming service, but much, much bigger. They added a whopping $211.7 million in net new ARR for the quarter. Talk about being popular at the cybersecurity party. Customer sentiment is also strong, with CEO George Kurtz highlighting that their Falcon platform is becoming the gold standard in cybersecurity. According to Kurtz, companies of all sizes are hopping on the Falcon train to improve their security measures and reduce their total cost of ownership. Kudos to Falcon for being the Swiss Army knife of cyber defense. Let's not forget, CrowdStrike raised their guidance for fiscal 2025, now expecting revenue of $3.976 billion to $4.11 billion, and earnings per share between $3.93 and $4.03. That's like predicting you'll win the lottery and actually winning it. Analysts were so impressed that multiple firms either raised their price targets or maintained their strong buy recommendations. In fact, Jefferies even hinted that rising demand in generative AI solutions could be the next big catalyst for CrowdStrike. So if you were looking for a stock that's got the tech world buzzing and the numbers to back up the hype, CrowdStrike is your golden ticket today. Keep your eyes on this one, folks. It's shaping up to be a cybersecurity juggernaut for the ages. Stay tuned, tech friends. Tomorrow's news might just be the next big thing. Hold on to your virtual drafting tools, folks. Today, Autodesk has been hit with a trifecta of legal headlines. Whether you're an architect, engineer, or just a nerd for 3D design software, you're going to want to hear about what's been shaking up the company behind AutoCAD and Revit on the NASDAQ. First up, Robbins LLP has initiated a class action lawsuit against Autodesk. This suit is on behalf of investors who bought Autodesk securities between June 1st, 2023 and April 16th, 2024. The heart of the lawsuit claims that Autodesk's internal controls were well out of control. According to the complaint, Autodesk didn't properly manage its free cash flow and non-GAAP operating margin practices, leading to some serious financial fumbling. When Autodesk disclosed a late filing notice on April 1st, 2024, the stock price fell by $10.73 or 4.13% to close at $248.71 the next day. Fast forward to April 16, 2024, and they still hadn't wrapped up their Form 10-K. This delay caused the stock to drop an additional $13.32 or 5.83%, plummeting to $204.92 on April 17th, and diving a bit more on April 18th to close at $210.63. Ouch. Not stopping there, Pomerantz LLP is also jumping into the legal ring. Their lawsuit echoes the concerns brought up by Robbins LLP, targeting Autodesk's management and directors for potential securities fraud and other sketchy business practices. Autodesk's inability to file their annual report on time and the subsequent revelations about their internal investigation into free cash flow and operating margin practices led to the stock plunge we already talked about. With a history of recovering billions in damages for victims of corporate misconduct, Pomerantz aims to add Autodesk to their wall of corporate shame. And wait, there's more. Faruqi & Faruqi LLP, a national securities law firm, is also investigating claims against Autodesk. They too are highlighting the inadequate internal controls surrounding Autodesk's free cash flow and non-GAAP operating margin practices. Faruqi & Faruqi are calling out investors who suffered losses north of $100,000 between June 1st, 2023 and April 16th, 2024 to step forward and perhaps snag the spotlight as the lead plaintiff. With offices scattered across New York, Pennsylvania, California, and Georgia, this firm's no stranger to high-stakes legal battles, having already recovered hundreds of millions for investors. So, what's next for Autodesk? As these legal battles unfold, shareholders might have the chance to recover some of their losses, provided they join the class action circus by the June 24, 2024 deadline. Each law firm handling these cases, Robbins LLP, Pomerantz LLP, and Faruqi, comes with their own hefty credentials and a history of scoring big for their clients. The upshot? While Autodesk might be a titan in the world of 3D design and engineering software, it's clear even giants can stumble. Keep an eye on those court filings and maybe, just maybe, think twice before hitting that buy button on ADSK stocks until the dust settles. Hold on to your keyboards, tech enthusiasts. MongoDB has been making headlines in a big way today, and it's a roller coaster of a story. If you've watched Silicon Valley and are used to 3-episode story arcs packed into one season, then you'll feel right at home. First off, the news that really shook things up. MongoDB stock took a nosedive, plummeting over 35% in May. Yes, you heard that right. 35% of their value vanished quicker than the last donut in the break room. The culprit? Disappointing forward guidance from their latest earnings report. While their Q1 revenue and non-GAAP earnings per share actually beat expectations, it's the cautious outlook for the coming quarters that spooked investors. Revenue guidance came in below analyst expectations, and they lowered full-year estimates too. Combine that with MongoDB's already high price-to-sales ratio, and you've got a recipe for a stock tumble. Next up, let's dive into the options market where the big players, think whales but wearing business suits, are making their moves. The smart money seems split on MongoDB. While some are betting on the stock, a larger chunk appears to be bearish, as evidenced by a slew of put options. Out of 14 notable option trades, only 4 were calls, valued at a modest $195,440, while 10 were puts with a hefty $956,107 on the line. This high-stakes poker game around MongoDB's future is tracking a price range of $230 to $410 over the last 3 months. Anything but dull. Finally, the skeptics had their say, throwing cold water on MongoDB's AI dreams. While CEO David Echeria enthusiastically painted a rosy picture of AI-driven future opportunities, some industry analysts aren't convinced. With stiff competition from giants like Amazon Web Services, Microsoft Azure, and Google Cloud, alongside a host of smaller but fierce competitors, MongoDB's path to AI dominance is anything but guaranteed. Add to that a steep valuation and lackluster growth expectations, and some would argue MongoDB's stock might still have further to fall before it truly bottoms out. So what's our takeaway? MongoDB was hailed for its pioneering document-based architecture that adapts well to both structured and unstructured data, a seemingly perfect fit for an AI-powered world. However, they are navigating choppy waters when it comes to actual market performance and future projections. Whether this dip creates a buying opportunity or signals a longer-term struggle is the million-dollar question, or maybe in the case of MongoDB, the billion-dollar question. Now, it's your turn to weigh in. Do you think MongoDB will bounce back stronger, fueled by AI advancements, or are you siding with the skeptics who see rougher times ahead? Drop your thoughts in the comments below. We love hearing from you. Let's get this conversation started. What's your take? All right, tech aficionados, let's talk stock strategy, and today I'm putting the spotlight on CrowdStrike. Based on today's news, here's where I stand. I'd recommend a buy. Why? Let's break it down. 1. Stellar financial performance. CrowdStrike reported a blowout fiscal Q1 2025 with $921 million in revenue, which was $15 million over Wall Street's expectations. That's like bringing extra dessert to a party. Everyone's thrilled. Their free cash flow reached a record $322 million with a 35% margin, which means they're not just making money, they're absolutely raking it in. 2. Impressive growth metrics. Their annual recurring revenue surged by 33% to $3.65 billion. This kind of growth in ARR is like having a money tree in your backyard. It signals long-term stability and ongoing customer loyalty. Plus, their bumped-up full-year revenue forecast of around $4 billion shows they're confidently predicting more of that sweet, sweet growth. 3. Rising demand. The commentary from analysts, particularly Jefferies, about an uptick in demand for generative AI solutions is a huge green flag. AI is the buzzword of the decade, and CrowdStrike's positioning within this space could be a massive catalyst for future growth. 4. Strong market sentiment. Multiple firms raise their price targets post-earnings. When the experts get excited, it's a good sign. They're seeing the potential, and their optimism often mirrors or influences wider investor sentiment. However, and this is a big one, go into this with your eyes open. Stocks are volatile, and what goes up can sometimes come down. Just ask anyone who's watched a squirrel on a trampoline. Always do your own research. Consider your financial situation, risk tolerance, and investment goals before diving in. So that's my 2 cents. CrowdStrike looks like it's ready to rock and roll, and now might be the perfect time to hitch a ride on this cybersecurity juggernaut. Phew, what a roller coaster of a day in the tech world. From Google's enticing pixel price drops and executive shakeups, to CrowdStrike's financial triumphs, Autodesk's legal hurdles, and MongoDB's rocky stock ride, today's market activity is nothing short of electrifying. If you enjoyed this update, make sure to like, subscribe, and share the video with your fellow tech enthusiasts. And don't forget to return tomorrow for another jam-packed tech news rundown.